Welcome to Wealth Builders Real Estate Investing Podcast with your host, Marcus Cron. We interview experts so you can understand all aspects of real estate investing. Whether you're a passive investor or an experienced syndicator, this podcast can guide you on your journey of building wealth through real estate. If you want to get in touch with me directly to learn more about real estate or to see all of the available podcast episodes and show notes, visit my website, marcuscron.com. Hey guys, Marcus Cron here. Welcome to Wealth Builders Real Estate Investing Podcast. Today I'm joined by Robert Beardsley, who brings a wealth of knowledge in acquisitions and underwriting deals. So I'm excited to let him share his expertise today. So Robert, welcome to the show, man.
Hey, thanks for having me.
All right. Yeah, no problem at all. Really appreciate you hopping on to share some knowledge with my audience. So a little bit about Robert. Robert Beardsley oversees acquisitions and capital markets for Lone Star Capital and has identified, negotiated, and structured over $100 million of multifamily real estate transactions. He has evaluated thousands of opportunities, including proprietary underwriting models. He has a popular newsletter read by hundreds of real estate professionals and has published over 50 articles about underwriting, deal structures, and capital markets. Robert also helps run Greenoaks Capital, his family's real estate investment and advisory firm. All right, so that's it sounds like you got quite a bit of experience in underwriting, and even come up with some of your own proprietary underwriting models. But before we kind of dig into things here, Rob, I'll let you tell a little bit more about yourself.
Yeah, sure. And it's always good to hear a nice intro about myself that I wrote. So that feels good. But thanks for having me on the show. And like you said, definitely my experience is focused on the analytics side, evaluating a project from the ground up and then layering in different structures of the deal on the debt and equity as well as the partnership side of things. So all that kind of stuff is really fascinating to me, like a puzzle. I always think there's unique ways to create value rather than just, win-lose or lose, win-win. There's always a unique way to look at something and create the most value. So that's something I'm always interested in and looking to do. So I grew up in a real estate family, so real estate was on my mind from an early age, and got to see my parents both being involved in real estate. And not too long ago, my family all together, we got into multifamily. We were more so on the single family development and sales and things like that. And, multifamily opened up the door to a lot of new relationships and a lot of new opportunities, where I was able to learn quickly from mentors and other people in the business. And I was very fortunate to actually meet my business partner along the way. And together we formed Lone Star Capital, which is now my main focus, which is finding, acquiring, and managing multifamily opportunities primarily in Texas.
Awesome. So it sounds like you grew up with real estate in your blood. Was there like a point in time, or was it the fact that you were basically, hey, I knew I was going to go into real estate all along, or was it kind of, hey, felt it out and you kind of got really hooked on it at a point in time? Or could you kind of tell me, what made you make that leap or go into, follow the family into real estate? Could you talk a little bit about that?
Absolutely, yeah. It's actually not at all happened that way. Growing up in Silicon Valley, there was, pretty much everybody's parents went to Stanford nearby, or Harvard. Everyone just had such great pedigrees and backgrounds and focused on tech. And everybody, the number one thing to do was start a startup and be a unicorn and sell, go public or get acquired. And so that was kind of where I was being pushed, just more so due to my, where I was brought up and the zeitgeist. So I really, I went to school for computer science and information systems, and I was involved in technology type stuff. And that's kind of having that brain of, solving formulas and building algorithms and things like that is translated nicely and something I really enjoy. But it really wasn't a direct path from, real estate family to real estate. But what ended up happening is that just over time being interested in investing as a general principle, you kind of look at the stock market, and that's kind of especially right now, if you look at it, it's a crazy place. So, it kind of naturally ended up coming back full circle back to real estate after evaluating all the whole investing universe.
Right. No, that's awesome. So, I appreciate you sharing a little bit about your background and how you ended up where you are today, and leading to your founding of your group, Lone Star Capital. But what I really want to dig in today is, you've got a lot of expertise in structuring deals, in underwriting. So I really want to dig into that today. So, could you talk, just to start off here, could you talk about some of the typical fees that should be expected in a syndication deal?
Sure, absolutely. So, and you brought up syndication deal, which is, a very specific type of deal. Obviously, you might be buying a multifamily property, but there's a million ways to buy it, right? You could buy it with all your own capital. You could be a limited partner with many limited partners in a large syndication. You could do a joint venture where maybe you're the capital partner, and then the sponsor or partner is the person on the ground doing the deal. And that's really just a much smaller partnership. And so, or there's a fund vehicle. So, when we're talking about specifically syndications, we're usually seeing an acquisition fee paid up front at closing, which is typically based on how large the deal is, either purchase price or total capitalization, which would be purchase price, closing costs, capital expenditures, and that's typically 1% to 2%. And but wait, there's more. You have at closing, often you see a loan guarantee fee, which would be based on the loan amount, which makes sense. Typically even on a non-recourse deal, a sponsor is going to need to provide their balance sheet and their experience, and they'll have to sign non-recourse bad boy carve-outs, and sometimes more actually personal guarantees depending on the loan. But so that requires having worth ample liquidity, experience, reputation with the lender. So sponsors feel they can charge, a separate fee for providing that to the deal and taking on a little bit personal risk. So that's typically, I'd say, 0.5% to 1% of the loan balance. And that's, mostly it ends there on fees at closing. But, there's also maybe a due diligence fee where, especially you see for sponsors that are vertically integrated, where they're running the whole operation down to the leasing agents on site, to the in-house construction and things like that. It's expensive to have your team drive or fly out to a site and perform a 2-day full unit walk. It's many people to walk all the units and perform a lease audit, and there's also technology involved, so there could be fees there as well. So it's not uncommon to see a due diligence fee. So those would be the fees up front. And then to try to wrap this up, you've got typically property management and asset management fees on an ongoing basis based on revenue. And property management fees are 3 to 4% on a larger multifamily deal. And this may not sponsor. So if the sponsor is hiring a third-party management company, boots on the ground, that'll be going directly to the property management company. And then the asset management fee would be going to the sponsor, which is 1 to 2%. So, and then you've got less common, you've got disposition fees, which would be a percentage of the sale. So 5 years down the road, you sell the property for $20 million. There could be a 1% dispo fee. And there's also refinance fees. So if there's a refi event during the whole period, there would be a fee there. So fees.
Mm-hmm.
There's many different types of structures where you may want to be fee heavy, but then more favorable on the performance, or want to be really light on the fees and say, hey, I want to perform, which they can incentivize them differently and can resonate with different investors.
Yeah, so it really comes down to aligning with investors. I mean, investors aren't going to want to see, hey, fee stacked on fee stacked on fee. They want to see that it's aligns, it's in the best interest for that operator to perform well and get paid on the back end instead of just collecting fees up front along the way. So what are you seeing typically in deals these days, which is like an industry standard where, hey, these are the fees that most sponsors are charging, where it's not kind of like overwhelming? I know I've seen. Well, I'll let you talk about it here.
No, so you brought up a good point about the alignment of interest and incentives. And fees aren't necessarily bad because, for example, let's just say a refi fee, there's an incentive for the sponsor to refi, which rather than sell. And there's inherent built into all these structures, there's almost always a bias towards selling because that's, like you said, make your money on the back end. And so a sponsor is going to want to sell. But if I'm a longer term holder and, you as an investor, you may say, hey, I like the conservative nature of hold in a quality location. That may not happen if the sponsor is incentivized to exit early. So if you can find a structure that works for you and the sponsor that maybe gives them a little more incentive to stay in longer, maybe better ongoing fees or a participation in the profits on an ongoing basis, and things like that, that can align your investment thesis with, the fee structure and all that. So, but to, like you said, for just a clean example, I would say most commonly seen in a syndicated deal would be a 2% acquisition fee, 3% property management fee, whether it's insourced or outsourced, 2% asset management fee. So we're looking at a 5% all-in management fee, and then an 8% preferred return, which are starting to be 7 on some higher quality deals or better sponsors. And then it's kind of all over the board, 20% to 30% on the promote. And then actually something we've been seeing more of lately is a tier 2 hurdle, which would be the promote increases over a certain performance threshold. So let's say the deal after sale hits a 15 or 20% IRR hurdle, the promote will actually kick into a higher level, let's say going from 30 to 40 or 30 to 50, and really juice the sponsor's returns, which some investors may like and some may not.
Right. So you brought up a lot there that I wanted to lead into and kind of let you untangle that if some of the listeners don't really understand all the terminology there. But my next question is, hey, explain the preferred return. What is it? How does it work? I know you already mentioned what's average there, but we're seeing 8% preferred return is kind of standard these days. But talk a little bit about preferred return, how it works, and share that.
Yeah, great question, because it would be so easy to not even think that would be hard to define, right? But a preferred return actually has many different iterations, and you can structure it any way you want. So it's really important as an investor to fully understand what you're getting yourself into and read the PPM. I was listening to another podcast where they're kind of joking. They're saying, "How do you PPM?" And they're saying, basically, do you wake up early on a Saturday and get a coffee and sit there for 4 hours and read the PPM? Because nobody looks forward to really reading those things. They're brutal legal documents, but really important to at least read one from start to finish once in your life. Maybe you never have to do it again, but I was actually reading one just last night, just kind of absorbing and seeing about different wrinkles and how are other people doing deals and things like that. So the detail is important. So on the preferred return, taking a step back, the purpose of a preferred return is really to be a protection mechanism for investors to help ensure that they're going to meet a minimum return threshold, and yet still allow the sponsor to be compensated if they do perform and hit a double or even knock it out of the park. So the preferred return, let's say at 8%, is a senior payment made out of the cash flows as well as a refi or sale, and that those senior payments are due investor first. So if a property is performing and kicking out a certain percentage of cash flow, that first 8% is due investor before the sponsor can receive any of their profits. Now this, if the sponsor is also investing their own money into the LP, then they'll also be participating in the preferred return. So there are structures where the GP has a capital account. Let's say the GP is investing 10% of the equity. It'll be both the GP and the LP's money will receive an 8 together. So if it's 6, they both just getting 6, no difference. If it's 8, they both hit 8. But if it's 10, they can hit the 8, and then now the sponsor will get a little bit more. They'll get a disproportionate amount of the share of the remaining profits. So, and as you can see intuitively, that's a protection, because if it's not 8, if it's less, then it's all going to the investors. And the one wrinkle that I want to bring up is the fact of whether or not being a preferred return based on cash flows, or if it's a total return and IRR based hurdle, because there are some hurdles that entitle the sponsor to receiving a portion of the cash flows on an ongoing basis. And then there are others where the sponsor makes no money from the profits of the deal until the investors have received 100% of their money back and their preferred return, and then the sponsor makes money. So that's a huge protection mechanism for an investor. So, in my opinion, depending on the deal, that could be very attractive for an investor, because it's such a easy thing for an investor to understand and say, wait, the sponsor isn't going to make any money until I've gotten all my money back. So I've de-risked the deal for myself, and I've received a minimum return of let's say 7 or 8%, which is pretty competitive. So that is, I like that pitch. But if you look at it, we're talking about incentive to sell early. Think about it. If I'm a sponsor and I'm making nothing on the promote until sale, I mean, it'll be hard to convince me not to sell.
Right.
Yeah.
And right there, you just mentioned promote. So I want to dig into that next. That usually shows up on the back end when we're talking about sale, and how the GP gets compensated when they actually manage a deal well, they make a profit, and then some people even call it a profit split. Some people call it a carried interest. Could you kind of unpack that and tell what that really is, define it, and how you've seen it structured in typical deals these days?
Yeah. So like you said, there's a couple names for it: the profit split, promote, carried interest. So the most classic definition of it is whereby the service provider or the service partner is able to receive a disproportionate share of the profits. That's why, profit split. And so, and going back to the pref, it's very closely connected to the pref, because it's hard to talk about promote without pref. Although you do see some deals without a pref, which in almost all cases is a very uncompetitive structure. You almost never, there's no pref involved that is actually on a net basis not more expensive. So if you see that, typically it's an expensive deal for an investor to go into. But if you're an investor looking at long term, you might say, hey, I like the idea that the sponsor is getting a percentage of the profits, right from 0% cash flow and on, because they've got a lot of incentive to just stay in the deal and keep performing it. So, dollar for dollar, for every dollar the investor makes, the sponsor is getting a piece of that as well. So, for the longer term, that may make sense. But going to the promote side, like we talked about, assuming there is a pref, once the pref has been met, whether it's been met on a ongoing basis and you're hitting 8% on the cash on cash, and there's actually excess, the sponsor can get, let's say, 20 to 30% of those remaining cash flows. So the quick, easiest math to do would be a deal where it's an 8% preferred return and a 25% promote, and the deal is kicking out 10% cash on cash. And that would be, and for someone who doesn't know cash on cash, that would simply be you're making 10% on your money. So let's just say $1 million and the deal's kicking out 100,000. So the first 8% of that 100,000 or 80,000 would go 100% to the investor, to the LP. Then you've got the remaining $20,000 or 2%, totaling the 10. And that 25% promote would be taken out of 2. So to do the math, that's 0.5% would go the GP. So in the end, that 10% out of that 9.5 would go to the investor, and 0.5 would go to the GP. So you can see when the pref is involved, if you think abstractly, well, 25% of the profit, that seems like a lot. But if it's subordinate to that pref, they're actually taking a pretty small chunk out of that cash flow.
Right. No, that was a great explanation, and I'm glad you shared that with the listeners here. So the next thing you were mentioning was internal rate of return, or IRR, and an IRR hurdle. First of all, could you kind of define what is IRR and what is an IRR hurdle?
Great. Yeah, you're just laying it up perfectly for me. So IRR is a tough one because it's so universally used, right? Like every single deal is always slapping an IRR on itself and pitched itself with an IRR. People, just because they see it so often, they don't even think to wonder what it means or really closely define it. But to start, I'll just give the textbook definition, which for most people make no sense. So it almost adds no meaning, but I'll just say the IRR is the discount rate at which the net present value of the future cash flows equals zero. So it doesn't make any sense, but if you have a decent grasp of net present value, that formula requires you having cash flows and dates or years or time periods assigned to those cash flows. And the goal is to then use a discount rate to discount those cash flows back to present day. So, a dollar today is worth more than a dollar tomorrow. And there's many reasons for that. Number one, I like money now. So there's that opportunity cost, and then obviously inflation. So money is worth more today just due to inflation, and also risk. Money in the future is more risky. I want my money now. So that discount rate it's an implied calculation on the IRR. So if you basically say, hey, this deal has a 15% IRR, what that means is the deal is discounting future cash flows at 15%. So if you personally have a discount rate of, let's just say 10% because you have access to certain investments, and someone says, hey, I have a 15% IRR deal, and assuming that you're taking the same amount of risk as your typical discount rate allows you to, then that's a great deal for you because your discount rate's 10% and 15% is more. So, that's kind of the application of it, but the more intuitive understanding of IRR is, and the way I like to explain it is it takes lumpy cash flows and it normalizes them, because alternative investments are lumpy because you have a big cash outlay, and then maybe if it's a turnaround, there's no cash flows year one, then the cash flows build up, then maybe you refi, and then you hang on for another couple of years, and then maybe you sell finally and get your big pop. So there were lumpy, uneven cash flows there, and it would be really difficult or inaccurate to put just an annual return and say, well, this year you made 7, this year you made 12, and then the next year you refied, you got 30, so let's average them out. So the way that the IRR normalizes it is it basically converts it to, what would this investment look like? What would these returns look like if they weren't lumpy and they were simply a bank account with an interest rate, or any compounding interest bearing product, which, you think about just a bank account. You put $100 in, it goes to 101, and then the 101 earns, so your interest is earning interest. So that's the factor of the IRR.
Awesome. So I feel like you really broke down deal structure great, and kind of gave a good, well-rounded, high-level explanation of, more than just high level. You kind of dug into those pretty deep, which is great. Now I kind of want to look at, if somebody's looking to structure their first deal, what structure is recommended for someone looking to do their first deal, and what structure should they be doing? I'm going to lead you a little bit in this, but sometimes you hear about that beginner's discount, where you might have to give up a little bit on the carried interest or the promote, or you might have to tweak a little things in the deal structure because you don't have that proven track record, so you need to give a little bit more to the investor. But could you kind of explain that a little bit more on how you've seen first time deal sponsors structure something that's going to be attractive to their investors?
Yeah, I think you nailed it right there, and definitely explained it well about the beginner's discount and things like that. I think the simple answer is, if it's your first deal, or you want to structure it so that it's easiest for you, you want the structure to fly under the radar. You want it to be as similar to market as possible, and even a discount too much starts to look fishy. It's why are you so, they might think something's wrong, or you don't have confidence in yourself, and things like that. So I would say a beginner's discount makes a lot of sense, but not too much to in the end kind of draw too much attention. You don't want the structure to draw attention to that. So I would say just try to be as normal as possible to whatever your investors are typically seeing. So what I recommend, whether you're a limited partner, but also even if you're a sponsor, is join investor groups and get involved in these communities of investors that are always sharing opportunities with each other and providing feedback on them, because you can just get it directly from the source. You've got a bunch of investors right there who are actively investing in deals, and they can tell you exactly what they're looking for in a structure. You just say, hey, if I were to put together a deal, what's your, by still being reasonable, what's your dream structure, as an investor, assuming that investor is the avatar or the type of investor that you're trying to attract. So the structure, if you're trying to attract is a private equity firm, it's going to be vastly different than if you're trying to attract a retail investor or, less sophisticated. So, I think you nailed it with the beginner's discount.
Yeah, no, and to your point there, where you don't want to be too far off of market. I've even heard of sometimes when they look for the profit split and they go, say, 90 to the LP and 10 to the GP, or even lower than that, because they're just trying to convince the LPs to come in and be like, hey, this is a good deal for you, get in on this. Where if there's not enough in it for the GP, it's going to raise all types of questions. There's going to be skeptical LPs because they're going to look at it and say, well, if this thing starts underperforming, this investment doesn't go well, what's in it for you? You're just basically going to walk away and there's no skin off your back. So I think it's a way to protect. I mean, stay close to market, but don't discount it too much. So really good points there that you had on that. So to kind of close off on first deal structure, like maybe you've already brought it up already, but what would be your best advice for someone looking to syndicate their first deal?
Yeah. So like you said, if there's not enough not enough motivation, then they could, like you said, walk away or not really be motivated to work super hard for that, compensation at the end of the deal or even during the deal. That's another, I've seen, sophisticated investors actually say, I like when a deal has an asset management fee, because asset management fees are important to keeping the lights on and actually supporting an asset management infrastructure. So, jumping around a little bit, as an investor, you'd want to know, okay, well, what's the infrastructure behind this deal? What's this fee going towards supporting? Is there a team? Is there one guy who's managing this and he has a salary and things like that? So I think as a sponsor, if you just explain, if an investor asks, if you just explain, this fee is going to cover our operation and it's going to allow us to scale and actually improve our ability to perform and deliver, I think, that makes a lot of sense. But going to the first deal, like you said, to be as close to market based on whichever investor archetype you're trying to, but I would say a 1% to 2% acquisition fee again, 2% asset management fee, an 8% preferred return, and a probably 20% promote. I think if you show that, you're still making, as a sponsor, good money. You're getting a nice fee up front and you're getting ongoing revenue, but that 20% promote on the back end, I think is a nice, again, you don't want to be kind of at risk of, well, he has no incentive to perform. But I think that 20% definitely stands out in a good way. But the most important thing that all of the structure is literal cash skin in the game. No matter how good a structure is or, appeals to an investor, in terms of aligning interests, cash is way more powerful. So as a first-time sponsor, I mean, you could have market fees and forget the beginner discount. If you're willing to put up, 10, 20, 30 or percent more of the equity in the deal, that will be the best thing you can do. Obviously, that may be more difficult if, again, you're a beginner and this is, earlier in your career. So it may not be an option, but if it is, and family money works. If you could say, hey, my uncle who I fish with every weekend is putting a big chunk, he's my rich uncle, but he's putting $1 million in, that means a lot.
Yeah, no, because that's an awkward conversation when you're sitting at Thanksgiving dinner with your family member, and they're asking you, "Hey, where's my money? What's what happened with that investment?" So I mean, there's having that, like you say, family money in a deal. It can sometimes be just as good or better than the money of the sponsor. So no, that's great. So now I want to touch on a little bit into underwriting, and that process involves not only from the GP underwriting a deal, but also a passive investor underwriting a deal, not just taking the GP's word at saying, "Hey, these are the numbers. These fantastic returns. This is the IRR. This is the deal looks great." But there's a level of diligence that a passive investor needs to take. So involves in doing some underwriting. So what should a passive investor be doing to underwrite a deal?
Yeah, interesting topic, and tough, because as a passive investor, you're thinking, hey, I'm passive. I should be able to get to sit back and not worry about anything. I just make investments, get checks in the mail. But really, there's nothing passive about being a passive investor. It requires a ton of networking to meet and find the best sponsors that you resonate with, and build trust with, and then obviously, like you said, evaluating and underwriting their deals. So from that perspective, I highly recommend that passive investors do underwrite the deal, because I think it must be 1% or something like that of passive investors that do underwrite the deal. Obviously, for people that do it more professionally, or maybe they were in real estate and then they're retired and now they're investing passively, those people are most likely underwriting. And obviously, institutional investors that are still passive, and like family offices and private equity groups, they're underwriting everything. The level of due diligence they do is incredible. It's more than we do. They're climbing everywhere. So that helps sharpen me up. Just as an aside, I really appreciate when we are really sophisticated groups and they just tear us up, and we learn so much. But as just a passive investor, you should be able to do a quick preliminary underwriting. And not to say that you, like you said, sponsors, they're doing the work for you, right? Why double the work? They're underwriting the deal, they know the market, all that. But so you don't have to throw all that information that they put together away. You can use it, but you should still plug it into a model that like, and trust and understand. Because the thing about a model, as everybody knows, they're black boxes and garbage in, garbage out, and it's really hard to know how that model works. So, for example, the way my model is built, it could be very different than someone else's. Just my different assumption. I think that your sale value should be based on your trailing 12 NOI, and that includes reserves. So other people say, well, I'm not going to use my trailing NOI. I'm going to use my forward NOI when I sell. So if I'm going to sell in year 5, they actually use their year 6 NOI, and then maybe they tax adjust it because they're thinking about it from the future buyer's perspective. That's not neither right nor wrong. It's just there's all these different ways. But what I could tell you is, and it's not like that's right in your face. Nobody's telling you right in their model that, hey, my model is built this way, because it's all in the back. It's all in the formulas. And what I could tell you is I could change a couple ways of how I'm calculating my sale value. I could change a couple of the ways that I'm playing with my, not playing, but just accounting for my closing costs and different reserves. And with keeping all the operating numbers exact same, and the exit cap the same, and the rent growth the same, I could get a 4% difference in IRR, maybe more. So that just shows, a 4% difference, that could be the different 12, and that could be, yes, I'm investing in that deal, and no, it's just not good enough. So you can't just accept those numbers, and you have to work with your own model, or whichever model that you choose to get comfortable with, and start grooving it out, and feeling, hey, most deals that I'm underwriting through this model are coming in at 10 or 12. And maybe it's not actually a 12, maybe it's actually a 14, but it doesn't matter, because you want to understand what the typical returns are looking like. So that way, when a deal stands out in your model, whether standing out for you in your model is 15 or 18 or 22, it stands out.
And what kind of, in order to do this underwriting, I know you mentioned about kind of verifying their model and not taking it at face value, but plugging it into your own model and kind of verifying numbers. But what other information or due diligence materials do you really need to conduct that underwriting?
Yeah, so it's not hard stuff to get. You should, if you're receiving a deal from a sponsor, you can just ask for the rent roll and the T12. And also, it's nice if it's an on-market deal, which the vast majority of deals are on market. There's somewhere out in the universe is a nice glossy offering memorandum that was put together by the brokers selling the deal. So if they're willing to share it, they should be. Then you can get that, and that'll have its own version of underwriting, right? Brokers who are selling a deal are also underwriting the deal. That underwriting is typically known to be the most aggressive. So you never would want to see a sponsor that's putting a deal together to be as aggressive or more aggressive than the broker's underwriting who's selling the deal. Obviously, they're selling the deal, so they're trying to pitch it as a total home run. But it's still a good frame of reference to have. But without that, it's totally fine. If you just look at the T12 and the rent roll, that'll give you a good understanding of where property sits today. And in order to kind of better understand where its potential is, because most deals are bought based on the future potential and not just the in-place performance, that requires a little bit more homework, namely rent comps, where, if you don't have access to data services like Yardi Matrix and CoStar and things like that, then you might just have to Google and go on apartments.com and maybe call up different apartment complexes that are down the street or in the area. I spend a lot of time just calling up apartment complexes that are next door down the street to potential acquisitions, and I just say, hey, I'm interested in a 2-bedroom. What is that renting for today? Would you potentially give me a discount? Or I'm a good resident, or what kind of ancillary fees are there? You have to understand all the the nitty gritties of the rent comp. That's really the most time consuming.
Right, and you brought up a topic there of being, talking about the offering memorandum and talking about how brokers are going to be aggressive on the deals. Now, let's go to the opposite side. Given where we're at in the market cycle, you're really wanting to make sure that the sponsor isn't overly aggressive, but making sure that it's stress tested and there's a conservative deal that they can still hit their returns even if certain items don't quite pan out as they projected. So what are certain things that they should be looking for, or a passive investor looking for, to check for the how conservative a deal is?
Yeah, so the two classic, most common ways that the levers you can quickly pull to juice a deal, and they're talked about a lot, so they're kind of cliche at this point, but it's the rent growth assumption and the exit cap rate. So people are getting pretty savvy to this, and so it's those things are kind of out in plain sight. So it's pretty easy to spot if you see, hey, this guy's got 4% model. I mean, any deal would look good with 4% rent growth, and so that's happening less, I think. And same with the exit cap rate. People are looking, well, is your exit cap rate whatever their metric they think is good. So those still two metrics nonetheless are easy to tweak. If you just take your exit cap rate from 6.5 to 6, or 6 to 5.5, that can do a whole lot to your numbers. So as a passive investor, if you were just going to spend 5 minutes on a deal, and I did this the other day, I was presented a deal, nice glossy pitch deck, and I didn't really want to go through the whole thing. So all I did was I took the year 5 NOI. I made sure that it included replacement reserves. And I took the sponsor's numbers at face value. I just said, all right, year 5 NOI, I believe you. Made sure reserves were included. And then I divided it by my own exit cap rate, which for the location, it was an okay location, older asset. So I used a 6% cap rate, which cap rates are very local and they're always changing. So I can't just say a cap rate and then that's the one you should use. But for this deal, I used a 6% cap rate. And I think I got to a $24 million valuation. And the sponsor in their projections was projecting, I think, I don't know, must have been closer to $30 million on the sale. So, and I'm using his numbers. So, the way he got to his sale must have been by using a forward NOI, And then he was using, I think, a 5.5 cap or a 5 cap, and he didn't have reserves included. And, that's a huge difference, 24 million versus 30 million. So if you just look at the exit cap rate, that can be a big sign. And another point about that is if you see these kind of, when there's a judgment call of, well, should I use this number or should I use that number? And the massive assumption or number is used, and you kind of have to wonder, well, what does that say about the rest of the deal and assumptions and how this, sponsor is looking at this opportunity?
Right. No, that's really true. And I mean, I think the exit cap makes a big difference. It can really juice the returns, and it's a simple thing to, I mean, we're going to, sell it at the same, the exit cap's going to be the exact same as what we, our entry cap is. And we really want to, at this point in the cycle, be conservative in how we're underwriting deals. So I think I've heard somebody say, if you see a sponsor projecting that they're going to sell it at the same entry cap as the exit cap be the same as the entry cap, then you should run. But take that with a grain of salt. But yeah, it's just being conservative and just not looking through a crystal ball and trying to say, hey, like everything's going to be perfect. Well, things can change. So we really just need to be looking conservatively and make sure we can still hit our returns, even in a challenging time where rent doesn't grow as expected, or occupancy doesn't stay at the rates that we've been seeing in the last number of years. So yeah, no, that's great. So I want to ask you this, and I think I already know the answer, but I think it's interesting. How did you learn to underwrite deals? Like you're a younger guy. How did you become so affluent in learning how to underwrite these deals and build your own proprietary model? Like, how did that happen?
Yeah, it was really, I guess, out of necessity and just trial and working at it. So early on, as I started looking at deals, my initial thought was, well, hey, I'm sure there's already a good model that exists out there. I'll just go on Google and search for it, and then I'll download it, and I'm done. Save myself a lot of time. And my dad said, no, you're not going to do that. You're going to build the best one. And I thought he was crazy. I thought, why would I recreate the wheel? I'm going to waste so much time. I could just get one and be done with it. And I don't even think he knew how helpful it would be for me to embark on that journey. But I started doing it, and I built one from scratch, and it was horrible. And then I edited it, and then I downloaded every model I could find and started analyzing and tearing apart, breaking down all the models that anybody would send me, and try to learn from each one and take the best pieces from each one. And I'd say, oh, I'm so jealous of this model. I need that function. And I would just keep incorporating, the best pieces until I got to a pretty nice working model. And then from there, was kind of establish that and then make some smaller edits over time and some still bigger overhauls. I actually had a big overhaul just in December where I locked myself in a conference room for a few days straight and just spent 12 hours a day kind of rebuilding some things. So it's been a great experience because, like I mentioned earlier, unless you've built it, you don't really know how it works. So it's great for me that I can confidently understand how each formula and different assumption work in the model. So that's been very valuable to trust the underwriting, learn more about the business, and yeah, it's been a great experience for learning and building on it.
Yeah, no, that's awesome. I mean, sounds like you just learned the business so much better by just going through that process and getting the repetitions and really, thinking through it. So that's really awesome and inspiring for others out there as well. So maybe others might be inspired to go out and build their own model. Well, we'll see if they can handle the 12 hours days like you mentioned. But I want to be respectful of your time here and wrap up this conversation. But what I want to take it into our final 4 questions where you just give short to the point answers. So, what is your favorite real estate or business book?
Investing in Real Estate Private Equity it's a pseudonym because the real person that wrote it is Paul Caseberg. But the pseudonym I think is Sean something. But if you just Amazon it, it's a good one.
All right, I'll have to check that one out. What is one thing you wish you knew when you got started in real estate investing?
Wow. I would say there's a lot more to it, and partners, mentors.
All right, there you go. So what's a daily habit that helps you be successful?
Read, read everything you see, and network.
Awesome. So what do you do for fun when you're not crunching numbers in your models?
Working out, reading, golf.
Awesome. I love reading as well. So last one here, wrapped up all our questions, but I want to give you a chance to share how can our listeners get in touch with you?
Yeah, if you're looking to embark on that model, or that sounds horrible and you just want mine, feel free to reach out to me directly at rob@lonestarcapgroup.com. You can check us out at lonestarcapgroup.com, just the website. Drop your email there on the website, and you'll get an email with a lot of content, including my underwriting model package, which includes some how-to videos, obviously the underwriting model with some more tutorial type stuff. So there's a lot of good resources there. Awesome.
No, that's a lot of value, and it sounds like you put a lot of hours into that. So I think I might even reach out to you about that. That sounds great. Well, it was really great to have you on the show today, Rob. Really appreciate you sharing your knowledge and adding value to our listeners. So thanks again, and hopefully we can talk to you again soon.
Yeah, thanks for having me.
Okay, thanks. Take care.
If you want to get in touch with me directly to learn more about real estate or to see all of the available podcast episodes and show notes, visit my website, marcuscron.com.
Thanks for listening to the episode. If you enjoy the show, make sure to subscribe so you don't miss out on new episodes. If you enjoy the podcast, or if it provides value in any way, make sure to leave a 5-star review. This helps the show attract top quality guests who will be able to provide even more insight into how you can build wealth through real estate. Talk to you next time.